We're back, and this week we've got another high growth ETF list for you. These 6 ETFs have all performed very well over the last year, and they all come in under $70 a share.
The ETFs focus on a variety of industries and sectors, so if you're looking to diversify your portfolio, one of these might just be perfect for you.
Before you go and click on that buy button though, make sure to put a little more due diligence into your choices before adding any of these ETFs to your portfolio.
Of course, this isn't financial advice, it's just some random ETFs mixed in with a few corny jokes. Let's jump into our 6 low-cost, high-growth ETFs. Max, the floor is yours.
Well, our first ETF should be in the Guinness Book of World Records for the longest name.
True.
Which is, wait for it.
Okay.
The State Street SPDR Portfolio S&P 1500 Composite Stock Market ETF, ticker SPTM.
This follows the top 1,500 companies in the S&P Composite 1500 Index, as the name suggests. Similar to one of the most popular ETFs out there in VTI, SPTM has identical top holdings.
But without the hefty price tag per share. It comes in at an affordable share price of around $57 and an expense ratio of just 0.3%. It doesn't get any lower than that.
Seriously, that's the lowest.
Year to date, the return is over 26%, and it has a 5-year total return of, listen to this, 129%. It's hard to beat these kind of returns unless you have a crystal ball in your hands.
Like with any S&P focused fund, it has Apple, Microsoft, and Amazon, which have all been dominating the market, and there doesn't seem to be any end in sight.
In terms of growth, we like that it has over 27% of the portfolio in the information and tech sector, because companies like Tesla and Google continue to tear up the market.
And as long as Bernie doesn't force Elon to completely liquidate his Tesla shares, this ETF should be okay for long-term growth.
Our next ETF might just be what the doctor ordered. Fidelity's MSCI Healthcare Index ETF, ticker FHLC. This fund tracks the healthcare sector in the US.
If you've been paying attention for the last few years, it's been doing pretty good. You can get started in this fund at a share price of $65, and the fees are going to cost you around 0.08%.
The year-to-date return is over 14%, and it has a 5-year average return of over 16%. Some of the top holdings include Pfizer, Johnson & Johnson, and Merck, which are all considered easy money as the governments try to roll out their products to every man, woman, and child.
Eric, it's just a little prick.
Alongside the pharmaceutical giants, there are a lot of innovative companies within the fund that may just find the cure for the common hangover. If that day does come, this thing could really take off.
Hey, hungover dads, want to go to a parade?
As we chip away at our list, the next one up is a brand new ETF, Invesco's PHLX Semiconductor ETF, ticker SOXQ, which tracks the semiconductor industry.
We found it difficult to find traditional ETFs that focus on the semiconductor sector with a reasonable entry point. Many options nowadays are either costly to get into or are leveraged ETFs that may be too risky for the average investor.
That's why we like SOXQ. It has a low share price of just around $30. The expense ratio is a little higher at 0.19%, but it has a year-to-date return of over 20% since it debuted this summer.
With the chip shortage being no secret, the top producing companies in the industry are reaping the rewards of the extreme demand.
SOXQ's top holdings are very similar to the massive semiconductor ETF, SMH, but without the $300 price tag. This list includes semiconductor giants like Nvidia, Qualcomm, and Intel, who are all top producers in their market.
The US has put extreme focus on expanding its chipset production, but these facilities won't pop up overnight. We see the shortages of chips continuing with strong demand, which is why it might be a great opportunity to ride the inevitable growth of this ETF.
Chip shortage?
Nah, man, we got lots of chips. We got regular, barbecue, and ketchup.
Ooh, Canadian classic.
You gotta have it.
Next up, we have iShares Core Dividend Growth ETF, ticker DGRO. Wait, did I say dividend?
Yeah, you did, and we wouldn't usually add a more dividend-focused fund to our growth list, but DGRO has had stellar performance over the last few years.
Taking a look at the numbers, it has a share price of $54 and an expense ratio of just 0.08%. The year-to-date return is almost 23% with a 5-year average return of over 16%. But the icing on the cake is the almost 2% dividend yield.
Passively managed by BlackRock, DGRO tracks US equities with a history of consistently growing dividends. The sector breakdown has heavy weightings in growth-focused areas like tech and industrial, but also has over 20% allocation to the financial sector for added stability.
Top holdings include JP Morgan and Verizon, alongside stocks like Apple and Microsoft. If you're looking for an ETF that has a broad market exposure with dividends and growth, this is one you might want to keep on your never sell list.
Gonna hold you in my arms forever.
Are you ready to put on your formal bathing suit? Because our next pick offers some great options outside the US borders. The Vanguard Developed Markets ETF, ticker VEA, is a fund that tracks foreign equities from developed countries around the world.
The share price is attractive at just over $50, and it comes with a typical Vanguard expense ratio of just 0.05%. Year to date, the returns are over 10%, and it's consistently been able to produce these returns over the last 5 years.
Top holdings include companies like Nestle, Samsung, and Toyota, which are all huge players within their respective industries. The fund is well diversified with large to small cap companies in almost every sector.
VEA is not only stable, but it's had solid returns for a long time. It offers great exposure to investments outside of your typical S&P 500 funds that we all likely already hold.
We like the price, the low fees, and the broad reach to some of the best companies in the world outside of the US of A. And you know what they say, variety is the spice of life.
That's a spicy meatball!
Our last pick is probably our most speculative, but with the recent upswing in the oil and gas sector, it may be worth a look. Fidelity's MSCI Energy Index ETF, ticker FENY, which tracks the US energy sector index.
The share price is very reasonable at just under $16, and the expense ratio is fairly cheap at 0.08%. With West Texas crude almost back to $80 a barrel, this fund has seen excellent growth this year with a year-to-date return of over 59%.
Although the oil and gas industry has suffered over the last few years, it could be time to get in on the ground floor, with the energy sector expected to rise quickly.
As far as energy sector funds go, FENY is recognized as being fairly stable and does offer a respectable dividend yield of over 3%. The top holdings include oil and gas giants like ConocoPhillips, Chevron, and ExxonMobil.
Speaking of Exxon, they've stated to have an inventory of almost 20 billion barrels of recoverable resources and is set to invest $15 billion over the next 6 years into reducing greenhouse gases, obviously to stay more environmentally responsible.
As much as renewable energy is the future, the oil and gas industry will still play a vital role until then. If your portfolio is overloaded with tech and financial sectors, it might be worth it to explore this oil and gas ETF. Just don't tell Greta.
How dare you?
That's it for our low-cost, high-growth ETF list. Let us know if you hold any of these already, or if we missed any of your low-cost favorites.
Meet us back here weekly as we've got you covered for all things investing with a little dash of cheesy humor. That said, I'm Max.
And I'm Mike. You got cheesies?
I got some chips.
Did you buy the dip?
I didn't buy the dip.
You always gotta buy the dip.